Hey YouTube, it's Victoria from TRADEPRO Academy. I hope everyone is doing well, and today we've got another video with a different background. So I hope you guys are enjoying our channel, and thank you all for coming to this video. Now, we've talked about this a lot. We've talked about this in many different factors. You've seen us just spam pretty much over the last few weeks about this proposed market crash, market dump. And today we're going to be talking about a little more before we dive into some other stuff, our regular content. So I want to talk to you guys about the 5 top stocks that I'm looking to pick up on a massive market correction or a market crash, right? These 5 stocks are a mix between value and growth, but these are stocks with high potential and good growth in the future. The stocks that you can hold for the next like 5, 10, 15 years, right? So if you guys want to listen to these 5 stocks, you probably have already seen them based on the caption and description. Just stick around and listen to what we got to say. So let's dive right into this. And these are based on what could happen in the market, right? From a fundamental and a global economic standpoint, what could happen from a technical standpoint, and what we see as the top 5 picks in our arsenal going forward with this potential market dump. So should we see a 2022 market correction that's over 30, 25%? These are the top 5 picks I'm going to stick by. So get ready for this video. We're going to dive into this intro, but before, I want to make sure you guys smash that subscribe button and hit that like button for more content like this. Let me know what you think about the background. Do you like it? Do you hate it? How are my monitors? So let's dive right into this and get it started. So the 5 names that we're going to be picking out are going to be names that are a fair mix of value and growth. Now, stock number 1 that you guys may have seen in the news quite recently is going to be Google. So Google is our first pick on the list. Now, Google is a massive, massive company, and it's a massive share price as well. But in recent earnings, we saw that get kind of altered. So why don't we talk about Google a bit? Now, Google is a massive search engine conglomerate, right? Maybe the most universal search engine that anyone's ever looked at, right? Google, or company, right, called Alphabet. So Google, ticker symbol GOOGL or GOG, right? Google. By the parent company of Alphabet, right? So they have the most universal search engine anyone's pretty much seen, right? It's everywhere, it's all over the world. And not to mention, they also have a huge component in YouTube. Now, YouTube, remember, serves a lot of ad revenue and creates its own revenue cluster right there. You guys are on YouTube right now, but don't worry, we're not going to be charging you ads or ad money for this, right? We don't have ads on our channel, but YouTube is amazing for the content creator, for the influencer, whatever that may be. And there's a lot of ad revenue and money on YouTube. Now, other than YouTube, right, huge search engine, and there's a lot of ads generated there. But YouTube's and Google's search engine aren't the only things there, right? There's a large innovative stream. They've also got phones, which maybe are not as popular as Apple's, but they've also got phones. They've also got other software. They got a lot of innovation coming out. And I really like Google in the long term. Now, it's one of the mega cap names that recently reported earnings. So as of February 2nd, right, the earnings report came out about $30.69 a share versus the 27 odd dollars expected. So a decent beat there in revenue, and $30 per share revenue is a pretty big thing. Now, naturally, the share price is pretty crazy, but they've also beat on the revenue scale. Now, in terms of revenue, right, just over $75 billion in a single quarter, right, of revenue versus about 72 billion expected. So a massive, massive increase there. And consider this, right? They're nearly $100 billion per quarter, right? Which puts them just under about $400 billion in revenue in a single calendar year. So that's very impressive, meaning they have a lot of cash reserves. Google's cash reserves, right, over the last bit, right, in September 2021 or so, were about $140 billion. Now, keep this in mind. Why are cash reserves important? Well, in declining market conditions, right, where tech stocks like Google usually get hammered down based on the current conditions, right? Right now, we're fighting inflation. And inflation and tech stocks, they don't mix together. But with a lot of cash in hand and a potential massive dump, right, this cash is going to be an attractive component to Google's overall fundamental picture. right? Not to mention, throughout the earnings report, Google finally announced, right? At $3,000, we have a 20-to-1 stock split, meaning if you own one share of Google, even if you bought it at $3,000, or if you bought it at 2,000, 10,000, whatever it is, right? It's not 10,000, but let's say like 1,500, you bought it a long time ago. You are now going to get 20 shares of Google at a split price, right? So if it's around $2,000 by the time of the split, right? Each share is going to be worth $100. So on and so forth. So by the time the split happens, which is going to be in July, there could be a lot of buying into Google to get in before the split is announced. So there's a very long extended time period between now and then. Remember, Sundar Pichai is not a dumb man. To add to that, right, we have to look at the PE ratio, and I like to look at mega cap names with PE ratios around 20, right? Maybe a bit less than 20. Usually 20 is a decent stopping ground, and Google is currently around 25. So should we see that fall in a large market crash condition, right? Once we hit maybe 2,000 on Google and we cut the price about 30% from where it's at right now, we could start looking for attractive scaling into this name. Now, I do think there's some more downside on this name. I think there's just a capitulation point in February, right? And March, when we start to see the rates come in, we're going to see that turnaround. So do we drop 30% in a single month, in a single week? Probably not. But if we do get that expected downside move in the market, Google is a name that I'm going to be very, very interested in picking up. Now, the next name, you probably know it very, very well. And we've got Apple on the list. So we just talked about phones, right? Made a little joke there about Google and their Pixel, but Apple, right? Very, very popular for the iPhone, that's done numbers over the last quarters. We'll see the earnings results. Apple is the largest publicly traded company, right, in the US with a $3 trillion market cap, right? The revenue numbers went crazy. So we recently had a stock split in Apple. I don't expect Apple to split again, but right after that 2020 dump crash, call it what you will, where we reflected about 30% to the downside, Apple got a split soon after, right? Cutting its price into the hundreds again. Now, this isn't the first time Apple split, right? They split over a handful of times, and I think they can continue splitting, meaning that there is more upside in this name. So Apple recently reported some wild earnings numbers, right? So these guys, $124 nearly $1 billion of revenue in a single quarter, right? Ending December 31st. Now that puts them at about $500 billion annually of revenue, about $500 billion in revenue. So Apple is one of those names that is everlasting realistically, right? It's always innovating. It's always pushing new products out, and people are just buying them regardless of how innovative they are, right? You know, you change a few cameras on the back of the lens, but regardless of that, people continue to buy them. There's high demand, even if prices increase. Now, Apple, what they've done is they've created multiple streams, right? They released the AirPods, for example, which do revenue more than individual companies, right? They have the iPhone sales. And speaking of iPhone sales, they've also come back to or near the numbers that they were doing back in China in 2015. So 2015 China iPhone sale numbers, which is massive considering that China has their own smartphones, right? The Huawei and others. So the fact that Apple is continuously getting global, even in spaces where it's considered maybe a second tier phone, right, in comparison to their domestic phones, Apple is still coming through, and there's more and more coming out, right? The demand is still there. They also mentioned throughout the earnings report that the supply chain issues kind of stifled some of the growth, meaning that the revenue and the earnings should have been that much greater. So once those are deteriorated a little, right, the supply chain issues start easing off, we're going to see Apple continuously generate more and more. Now, Apple, right, it's sitting at a PE ratio of about like 28. Usually it sits about 15 or so, but once we get back under that 20, it's going to be a very attractive valuation. It's around 175 right now per share. And when we get into that $120 area, it looks very, very attractive, right? It cuts a lot of price off. But remember, we're expecting a crash in this scenario. So these are names that I like to pick up at these areas. Now, another thing about Apple is, speaking of innovation, they haven't innovated too much, right, with these phones and whatnot. It's fairly similar, but demand is still there. Now, once they drop that Apple car that everyone's been waiting for, this thing is going to go for a ride, right, literally and figuratively. So we're all waiting for that, and I think they're just waiting for the right time to announce something of the sort. Right, huge market cap, decent hand on cash, around, I believe, 60 billion. It has dropped over the years a bit, but overall, Apple is doing very well, and a little higher on the valuation side based on where we're sitting at right now, because it turned into a safe haven over the recent dump. But if we have a larger move to the downside in the markets, we are going to see that attractive valuation yet again. Now, the third name on the list we've got Tesla. So Tesla is more on the growth side of things. And so far, we've talked about names that provide a lot of value, and they have been around for a very long time, and they've proven themselves with fat earnings reports, massive revenues. And you might be wondering, where does Tesla fit into this picture? Remember, Tesla still has a PE of around 300. However, it has been declining for a long time as they continuously post impressive and more impressive numbers quarter after quarter and year after year, right? So Tesla is one of those names that it seems fairly high right now, but a lot of people, Kathy Wood, wink, wink, may have price targets of 3,000. Whether you agree or disagree with Kathy Wood, there are more people out there with larger price targets, right? With 2,000, 3,000, 1,500, whatever it is, it's higher than the current $900 value. Now, with Tesla being more of a growth name as well and having a massive, massive following that pretty much cults around Elon Musk like there's no tomorrow, we can see a very substantial dip if the market dies, right? And Tesla is going to be one of those more attractive names around 500, 600, where it's created a lot of volume, right? Those are going to be areas that a lot of people are going to be picking up and institutions are going to be picking up. But Tesla's innovation and everything doesn't stop there. Now, I'm not talking about the robots Elon Musk was talking about, right? Let's forget about those robots for a second. But we're talking about supply chain issues, batteries, right? In the last earnings report, Elon Musk did mention that, hey, you know what? A lot of the supply chain issues have been resolved, mainly resolved, which is a massive component to their batteries, which is a huge part of their cars. Now, the other aspect of this report was that, you know what? We're not going to be coming out with a new model just yet. There's probably going to be one on the way, but the demand for the current models, especially Cybertrucks, right, is so high that if you go on the website, right, you're going to be waiting months, maybe a year to get a delivery. The demand is so damn high, right? People are continuously buying without getting their cars just yet, right? That is how popular Tesla is. And there's a huge following. The cars are pretty nice. And I think that's going to continuously grow. Now, will it hit 3,000 from 900? Probably not. Can we revisit lower? Yeah, that sounds about right. Now, the PE ratio is expected to continuously descend as revenue and earnings and all that stuff grows, right? So it becomes a much more attractive valuation and could potentially turn to a value name, right? The demand for these cars outweighs their competitors exponentially. In fact, even with no inventory, right? Some could say this is turning into the iPhone of cars. Now, the revenue from last quarter, right, was pretty good. It was about 18, almost 17.7 billion versus about 16.5 billion expected. So a beat on revenue. Earnings per share positive, as we've seen over the last few quarters, which have been $2.5 a share or so compared to 2.36 expected. So really good numbers there, and they're continuously progressing. So I do like Tesla. Should we pull back down, right? And I have a target area of between 500 and 600. I know it's a big target, right? But should we start descending in this market, I think that becomes an attractive valuation for this company. And who knows, maybe if I buy enough Tesla, Elon Musk will let me buy a real Tesla with some Dogecoin. Now, one of the last names here, right, is another tech company. So we've been battering tech left, right, and center. I do like tech, right? Not all the names on this list are tech, but tech has really good potential because the inflation scares right now, but also really good potential should we see a massive dip in the market to correct some of these overinflated PE ratios. And what we're looking for is quality tech that has the innovation and the backing to sustain something like this in the next 5-10 years. So the next name that we've got here is Nvidia. Now, Nvidia, we'll compare it a little to AMD throughout this, but overall, the PE ratio of Nvidia is fairly high, closer to 70, 65-ish, right? Which is a lot in comparison to the mid 30s of AMD. Now, Nvidia, where it differs is that the AI potential is one of the main attractants for this name. So in terms of innovation, software, chips, AI, all that good stuff in the next 5 to 10 years, NVIDIA becomes a very attractive investment should we pull down. NVIDIA also split fairly recently. Remember, it wasn't too long ago. I believe the split was July of 2021, and the price rocketed 40 to 50% after that split, right? A lot of buying came in. It had good earnings, right? All that good stuff caused a huge influx of buyers into NVIDIA. Now, NVIDIA is sitting around like 250-ish or so right now. Currently, it becomes attractive sub 200, right? 170 into that area. Now, it's already lost a decent bit from its highs, right? Just a lot of profit takers. And I think it can dip a little more, especially in a larger move to the downside. Now, as a chip maker, right, as a chip manufacturer, along with the AI, NVIDIA is the main component in the SMH, right, which is the semiconductor ETF, and it's closely related to the overall health of the market. So it is a huge component. I don't think it's going to lose that market cap and that market value, right? It usually prints about 2 times as much revenue as AMD on an earnings basis. And AMD absolutely crushed earnings this past quarter, just yesterday before I even recorded this. Now, Nvidia earnings are coming out. We'll see how those do, but expectations are they're going to do fairly well. To add to that, right, it's going to be a pivotal thing to watch in terms of the recovery of the overall market. So with the chip shortages, remember, it becomes more in demand, it becomes more attractive, right? I don't think these chip shortages are going to go necessarily away in the next year or so, but this becomes a very, very good name as one of the chip leaders. Now, the final name that we want to talk about here is going to be a boomer name. Shh, this wasn't on the list, right? A boomer name. Why would I do that? Why would I do that to you guys? But it's a great valuation name. And I think that even though it's not tech and it's one of those mega value, massive mega value cap names, I think it really, really deserves to be looked at in the case that we see a market dive and a 30-40% correction. Now, this name, I don't know if you guys have guessed it by now, but it's Mr. or should I say King Buffett, the king of values, Berkshire Hathaway, the B shares. So BRKB sitting around $320, $315 currently, right? At the lows was about 170 when I scooped it up in March of 2020. Now, this guy has even more potential. If we dive aggressively again, it's going to be a very, very good value pick. Now, Mr. Buffett's not a dumb guy. He has a lot of names in his basket of goods, right? And this insurance company has a lot of names that actually provide dividend. However, Berkshire does not pay out dividend. Otherwise, it would be even a more attractive investment. But I think this one is a long-term buy and hold, right? Which I'll be looking to buy the dip fairly aggressively should we enter under 220, under 200, it becomes a very, very attractive valuation. So Berkshire, right, with the massive value that it offers there, I think that it's just one of those names that'll slowly just continue grinding up as it accumulates value over the next 10 to 15 years, right? It doesn't move as well as a SPY ETF necessarily, right? It's not this one shot like 300% gainer since we've seen the lows in the recent years. But I think the steady growth in this name and the attractive valuations sitting at 8 PE, right? Its PE is 8, right? In its sphere, it's a pretty attractive valuation. And should that fall even further, right, in this larger downside move, we're going to get a lot of more money and a lot of investment coming into BerkB. Now, I don't really have too much to say about BerkB, but I think overall, just based on the value and the backing, it becomes a very attractive investment for the longer term. Now, these were the 5 main picks. Now, let's go over them again, right? We had Google, we had Apple, we had Tesla, Nvidia, and Berkshire. So all of these 5 names become very attractive investments for a portfolio coming into a market crash, right? I don't mean buy them now as protection, but if you want to learn more about protection in a downturning market, hit us up, community.tradeproacademy.com. We talk about this on a daily basis, or drop a comment down below if you want us to make a video. So these 5 names become very, very attractive at more attractive valuations. These aren't growth names, well, Tesla, right? But these aren't like all growth names that have these outstanding, like aggressive PE ratios of 200 without posting any profits, right? Those aren't names that I'm looking at in a dive. Because what may happen in this dive is that, okay, inflation fears start going away, but then rates are high, so they have to hike rates, they have to cut rates from the rate hike again. So they go from hiking to cutting and more stimulus. That's probably not what's going to happen. We're going to self-regulate, and the companies that have good value, right, the companies that have good earnings, good bottom lines are the ones that are going to sustain a lot of this damage. And this list of 5 is what I think that can maintain its upside trajectory in the next 5-10 years. So if you guys enjoyed this video, drop a like down below, smash that subscribe button, and let us know what else do you want to see before we get back to the screens in our coming videos.